Welcome back to another episode of the Doctors Building Wealth podcast. We're so excited to bring you a special series where we're featuring some of the keynote speakers from our 2024 Fast Fire to Freedom Summit. In the last episode, we featured best-selling author and real estate investing expert Jay Scott. Today, we have an amazing episode featuring Amanda Hahn and Matt McFarland. They are two seasoned CPAs, real estate investors, and they're also the founders of Keystone CPA, which is a CPA firm specializing in helping real estate investors maximize their tax savings. In their session, they shared the 5 essential strategies to help you save on taxes as a real estate investor. Some key takeaways to listen for are how to pay your kids and turn it into a tax deduction, how to save on taxes with short-term rentals, and whether you need an LLC to maximize your real estate tax deductions. This was a really great session, and we're so excited to share it with you. With that, here's Amanda and Matt.
My name's Amanda Hahn.
And I'm Matt McFarland.
And we are CPAs. Our firm is called Keystone CPA, and we specialize in working with folks who also invest in real estate and really want to know how to use real estate to reduce taxes, whether it's from their income, from their job, or from their businesses. So we're really excited to be here today to talk about 5 steps or ways to save on taxes if you invest in real estate.
Yeah, and we are real estate investors ourselves as well. So we like to say we're CPAs by day and real estate investors at night. So
not Batman by night, just real estate investors.
Yeah.
So like I said, we'll have plenty of time for Q&A today as well. But we do have a presentation because I think it helps for a lot of people to kind of hear what are some of the concepts, and then that way we'll have better dialogue and better questions at the end. But, why is everybody here? Well, I mean, obviously you're here because you want to pay less tax. I know for many of you, especially in the medical field, taxes is probably one of the biggest expense items that you have.
Yeah, now, so, we kind of call these the silent wealth killers. When you look at the highest federal income tax rate, it's at 37% right now. We happen to live in the state of California where our highest rate is actually 13%. And that might be shocking to some of you who don't live in California, maybe you live in a state that doesn't have any income tax. But you can quickly see that when you add those up and when you add in payroll taxes and capital gain, there's all kinds of taxes. They're not even on the screen, right? You can quickly see how people do spend more money. The average American spends more money on taxes than they do on food, clothing, and shelter combined. So let that sink in for a second, right? You're spending more money on taxes and what you think are your biggest expense, food, clothing, and shelter, right?
Yeah, and if you want to see if you're more of a visual person, here is the result from a organization called taxfoundation.org. For someone who makes $500,000 after, income taxes, payroll taxes, roughly what you typically have for the average American is about $199,000. So, it's really interesting because I think people tend to think that if you have high income, then that means you have a lot of money, right? Because you make more money, then you have more money. It's easy to invest in real estate and stocks. But the reality is that's not necessarily true. And in fact, there's a thing called Tax Freedom Day. Tax Freedom Day basically says every year they do an analysis to say, okay, if you're working all year long, at what month do you actually start to keep the money you're making? Historically, I think it's about June. So if you think about it, for half of the year, 100% of what you make goes to taxes. And then for the rest of the year, you get to keep what you actually
So that's one of those expressions that doesn't actually mean what it really sounds like, right? Like
tax freedom.
Yeah, it sounds like a good thing.
It's not freedom from taxes, it's freedom to.
But so this is the point here too, is this is without planning, right? This is without doing any true tax planning, is that someone who's making $500,000 is losing 60% of their money to taxes. And so, but when you add in proper planning, there are things you can do, and there's better ways to do it so that you can keep more of your hard-earned money, obviously. And that's what we're here to talk about today.
Yeah. There is, I think the media really has us think that tax savings is only for the super wealthy. But the reality is that those same strategies are available for all Americans. There's a judge whose name is Justice Learned Hand, and he said that in America, there are 2 tax systems, one for the informed and one for the uninformed, both of which are legal. And so it's really important to understand, he's not saying there's two actual systems or laws. There's actually just one set of laws, but they work differently depending on whether you are educated about taxes or uneducated about taxes. And so that's what we're here to do. We're here to bring more education and clarity into tax law, so that we know how to have it work for us rather than against us.
And as Amanda mentioned, there was a New York Times article that came out a couple years ago, kind of talking about that whole concept of like, hey, the super uber wealthy don't have to pay any taxes. That's unfair. They're using super secret strategies that aren't available to everybody else. And so, being the tax nerds that we are, we wanted to read this New York Times article. And what it kind of talked about was really things that everybody can use. It was talking about was tapping into the equity of your assets and not having to pay any taxes. And as a real estate investor, look, that sounds like a cash out refi to me, right? I mean, that's what you and I can do every day if we wanted to.
If you have your primary home that's gone up in value and you wanted to access that money to buy rental real estate, to invest in stocks, to go on vacation, it's the same thing. You can access that equity through a loan and not have to pay taxes right now. I think the article also went on to say that if you, for these wealthy people, not only were they able to access that money without tax, but they can also write off the interest on it, which is like, wow, what
wow,
atrocity.
Yeah. That's
but the reality is we can all do the same, right? If you tapped into the equity of your home or investment property and you use it to buy real estate or start a business, then those interests are business expenses, which you can write off against the associated business income too.
And then he even, touched on how these people were able to sell their assets and not have to pay any taxes right now. And it's like, well, that's a 1031 exchange that every one of us can do all day long, right? Now, granted, these guys may have more number zeros at the end of their number than we do, but the point being is that all the same strategies these guys can use is all the same stuff that you guys can use. And it's important, again, to just understand what is available to you, and be proactive in your process so that you can take advantage of it.
Yeah. And although the news article talked about, these very famous people, very wealthy people who can pay no tax, you guys probably hear a lot of some of these influencers or thought leaders in real estate who talk about how they pay little to no taxes using real estate. And you might be wondering to yourself, is it true when some of these people talk on social media or publicly about how real estate helps them to save on taxes? You see a picture of Leti on here, because I know her and Kenji talk also a lot about kind of their journey.
Sorry, Kenji, you didn't make the cut, buddy.
Kenji is somewhere. I think he's the very top.
Oh,
his face is
yeah. It's gotta be the screen.
But I know they share a lot about their journey to save on taxes, and so you might be wondering, is this true? Are these people really using tax benefits? And the good news is we're here to tell you, yes, it's absolutely correct. And how do we know? Because on the screen are all people that we have worked with when it comes to tax planning. And most of these people are not those who are trust fund babies or born with a lot of money. It's people who started their journey, maybe very similar to you, starting out with a job or a small business, and over time built and scaled real estate to create that passive income, and also to save on taxes at the same time. So not just for the super wealthy, but if you're someone who is looking to scale in real estate, looking to have real estate as part of your portfolio, then there's absolutely ways to save on taxes. And you don't even have to be like a real estate influencer or thought leader. You don't have
to be on Instagram all the time.
You don't have to be on social media. Here we just pulled a couple examples from our website for client testimonials. I think we have hundreds of them, but yours, is the couple that we thought to pull up, that are just average people who are able to use real estate to save, pretty significant amount in taxes. These are probably people you don't know or you haven't heard of them. But we share this just to let you know that, contrary to popular belief, tax savings is not just for the super wealthy, and it absolutely works for everyday investors as well. But when we talk about tax planning for real estate, we want to start with the first step, like how do we do it, right? There's a 5-step process that we go through with our clients. And then the first step is we have to buy real estate. Because without real estate, then there's no associated real estate tax savings or tax strategies. Like I said earlier, people think that high income earners have a lot of money to buy real estate, but that may or may not be true. We have a lot of clients who come to us and say, hey, I make a lot of money, but I have nothing to show because I've lost almost all of it to taxes. So the first step we want to look at is how do you tap into your assets to invest in real estate, but do so in a way where you're not having to pay a lot of taxes when you access that money.
Yeah, because I bet a lot of you probably feel the same way, because we hear this question a lot as people come to us, maybe they're getting started in their journey, and it's like, oh, where do I find the money to invest, right? Like they don't think they have they don't think they have the money, they don't think they have assets to tap into. But when you kind of get into that deeper conversation, kind of start peeling back the layers, we can kind of, there's a lot of opportunities there for people. So we kind of wanted to share.
Sorry. So with respect to hidden, tapping into your assets, I mean, some of the things that Matt talked about earlier, is like, being able to look at your portfolio or your personal financial statement and say, okay, well, where are all of the things that we can play with, right? It's what we call lazy assets.
Right. It's, looking at tax-free loans, right? Can you get tax-free loans from a family member, or a low interest loan from somebody that, maybe you've got money in stocks that you can access, right? There's all kinds of ways to tap into equity and wealth without having to pay any current taxes. And that's the key, because we don't want that tax drag to slow us down unnecessarily, right?
Yeah, when we have a lot of clients who have a good amount of their net worth in stocks. And so if you think about moving money from stocks to real estate, there's a couple different things, right? One is, how do we tax efficiently sell our stocks? Do we sell those with the least amount of gain? So that we can, keep the most proceeds to use in real estate. Or instead of selling the stocks, maybe I still want to hold on to my stocks. One thing to consider is, let's pledge our stocks as collateral and use that to borrow money from the bank. Another tax-free way to access that money too.
Yeah, another thing that comes to mind too is, what about retirement accounts or 401k money, right? A lot of people have their money stocked away in their employer 401k account. And then when we're talking about kind of accessing that, we're not talking about taking distributions or liquidating the account, because that would be subject to taxes and potentially penalties, right? But there are ways to kind of get access to that money without the taxes and penalties that you can use for real estate. And that's what a lot of our clients do. So we thought we'd go over an example of that, just kind of walk through a real life example of a client and the numbers, so you guys can kind of see that picture.
All right. So we've changed the name of the client just to make sure we protect the innocent. So this is our client, James. James is a physician. He makes over $300,000 of income, all of it which was W-2. He wasn't interested in investing in real estate because he heard a lot of his colleagues talk about it, but he doesn't feel like he has a lot of extra cash to invest. So, again, like many people, even though he was a high income between federal, state, payroll, taxes, he really didn't have much left in terms of liquidity. But also, I think like many people, a lot of his wealth was tied up in 401ks. He'd been growing it for a couple of years at his job. And now that he was getting into real estate, that was one of the larger buckets of money that he was able to access. But what James did was he called and he spoke with the plan administrator on the retirement accounts. And he said, hey, I want to use this money for real estate. And he was told that, well, if you were to do it, you're going to have to pay high taxes and penalties because he was before retirement age. And that would have been really, that really scared him, because that would have been really bad, because James was already paying high taxes. Now, if he were to liquidate retirement account, he's going to pay even more taxes and penalties. So what he'll have left is less than half of that money to reinvest into real estate.
Right. So what we did, and here's the plan, was instead of paying taxes and penalties, we had him borrow $50,000 from his 401k on a 401k loan. So that's tax-free, that's penalty-free, right? You just pay that back to the 401k over time. So, excuse me, getting over a cold, but so this is big for him because he could access that money without those current taxes. And then he also had some money in the stock market that kind of built up in value over time. His CPA told him, well, if you're going to sell it, you're going to lose more than a third of it, the taxes. Obviously, we don't want to do that. What we had him do was borrow from the stock portfolio, right? Do a margin loan on it. So he's able to access another $50,000 from the stock portfolio. All in, he was able to get a little over $100,000 in cash that was tax and penalty free that he can now use as a down payment to kind of start his real estate journey. So for him, that was a huge win, obviously.
Yeah. So we're looking for, again, the first step is buying real estate. And if you're trying to figure out where do I find the money to buy real estate because I don't have that much access liquidity to do it, then it's in looking to see where are our lazy assets and how can we put them to use tax efficiently. Okay. Now that we have real estate, the next step in the tax planning process is to make sure we maximize our tax write-offs. And as easy as that sounds, I feel like that
as unsexy as that sounds.
I feel like that is probably the most commonly overlooked tax opportunity area, because I think the reality is people just don't really understand what they can write off. I hear about these things I can write off, but can I really write off? Do I need to have an LLC? So one really important thing to understand is that regardless of whether you own your rentals in an LLC or not, you can take tax deductions as long as it is associated with your real estate business. Again, by business, I don't mean an LLC or corporation. I just mean you're in the business of investing in rental real estate. So here's some of the commonly missed tax deductions that we typically see. I think people are really good about writing off your mortgage interest and property taxes. But it's a lot of these sort of overhead expenses that we most typically see missed.
Yeah, I mean, some of the biggest ones that come to mind, obviously, are like professional development, dues. You guys are going to courses like this, business meals. You're taking somebody out to lunch. You guys are talking about business during the lunch. That should be a tax deductible expense. Maybe you're flying and traveling somewhere for a conference. Maybe you're coming to Vegas in March for Lady and Kenji's conference. I mean, that's going to be fun. We'll be there for that. So home office and car, other ones that are big expenses. Again, these are not the things that are directly tied to the real estate, like Amanda mentioned, like the interest and property tax and insurance. But these are that overhead costs that everybody incurs to run your real estate business, right? And we want to make sure you're capturing all these things because these are the ones that get overlooked the most often for various reasons. Like Amanda mentioned, people just don't know about it. God forbid, maybe they're unorganized. I mean, that never happens with real estate investors, but maybe it's a year later and you're trying to go back and like, oh my God, what did I spend money on? All those kind of things, right? So the point being is you want to capture these things on a recurring basis because these can quickly add up to thousands of dollars of deductions. And again, we were talking, a lot of people in a 50% combined federal and state tax bracket. Tax savings can add up to a lot, obviously.
Yeah, and something we didn't put on the slide here is income shifting. That's like a big one. That, if you have kids, help out in your real estate, or strategically think of ways for them to help out in your real estate, then you can pay them and take a tax deduction for it, right? There's nothing that says you can't hire your kids. So as long as your kids are working for you, what they're doing is ordinary and necessary with respect to your real estate business, then it's such a great way for us to shift income to our kids and turn it into a business deduction. When we talk about maximizing write-offs, we're not talking about going out and spending money recklessly just so we can, because we can write it off, right? That's just silly. But what we are trying to do is to take a look at what are we already spending money on anyways, and how can we turn that into a tax deduction? I think you probably agree with us when we say that most CPAs are probably not the most creative people in the world. I think like CPA, accountant, and creativity usually don't go together. But one of the tips—
I'm offended. Offended.
One of the tips we tell people is if when you're talking to your tax person, instead of just saying, can I write this off? Just ask, how can I write this off? Okay, because there's always an answer to the word how. How? Well, can I write off my kids? No. How can I write them off? Well, can they help out in a real estate business? Can they do XYZ for you? Then it kind of puts both of you in a more creative mindset to then think about what are all the things that you could potentially do. Can I go to Vegas and write it off? No. Well, how can I? Well, maybe you're going to the next event that Kenji and Leti put on. So that's the answer to the how question.
When talking about maximizing deductions for real estate, obviously we can't skip talking about depreciation, right? Depreciation is like one of our favorite topics. Why we love depreciation is we kind of refer to it as like a paper loss on your rental properties. It's expense you get on your return, and this is regardless of how much down payment you put on your property. So even if you buy a property with no money down, you can get the same amount of depreciation expense as if you bought it all cash. And so some things we love about depreciation, there's a lot of flexibility with it, right? You can slow it down, you can speed it up, you can even play catch up if you didn't take it the right way and there's a better way to take it. You can go back and kind of true that up and catch that up over the years. So that can be a huge potential to maximizing your depreciation expense. So we get a certain amount of depreciation every year. The question is, are we maximizing it to our best opportunity? Are we taking advantage of it? Because I think, I don't know, probably over 40% of the returns we review have depreciation that's done incorrectly in some way or another, right? Maybe it's not the right useful life. Maybe it's they skipped out on bonus. Maybe they didn't do a cost study, all kinds of different things. But the good news is you can correct all these things.
I'm always shocked in terms of when I review tax returns and I see wrong things on depreciation. And, I think historically we used to think like, oh, it's because it's a CPA who didn't understand real estate or for whatever reason. But I think lately we've reviewed tax returns that are done by very large firms who are well versed in real estate, where that's not being done correctly. So, but yeah, like Matt said, the good news with depreciation is oftentimes when there's a mistake, you can fix it. Multiple ways to do that. What we also love about depreciation is that the tax benefit is based on the purchase price of a property, irrespective of how much down payment you put on a property. So this is a really great example of where the tax law really encourages the ability for you to use leverage. Like if I bought a $500,000 property all cash, I get the same depreciation tax benefit than if I buy this $500,000 rental property with 20% down payment or, fully leveraged with no down payment. So that part of it is also really interesting. And that's how you see a lot of real estate investors scale up and really create that massive tax savings year after year. Is basically we're getting a tax deduction on the bank's money that we're borrowing, right? So we've talked about maximizing our write-offs. We talked about the whole benefit of depreciation. I know you might be thinking like, okay, that all sounds great, but what does that actually mean? Like in real life, are we talking about $5,000 in write-offs and tax savings? What does that actually look like? So we put together a couple client examples. These are real life client examples. We've obviously changed the names to protect the innocent. So you have an idea, like what does it actually take to save on taxes?
Yeah, so let's we want to share the story of John and Myra. So John's a doctor making over $400,000, and she's a stay-at-home mom. They've been investing for a few years, but never really knew how to take advantage of the tax benefits or thought they could, and kind of maybe got some not great advice. They had, I think, a portfolio of maybe 5 or 6 properties, if I remember when we started working with them.
Yeah, it's funny because, I think for John and Myra, they got into real estate similar to kind of a lot of you guys. John heard a lot about the wonderful benefits of investing in real estate from his doctor friends. And so when they first started, they were like, let's jump right in and get a bunch of rental properties. And they were super excited to save on taxes. But their excitement was quickly diminished, I guess, when they got their first tax returns done. And so they got their returns back and they didn't really see much tax savings. So they talked to their tax person and said, what's going on? How come I don't see a lot in tax savings? So the CPA said, oh, that was good. You didn't have to pay any taxes on your rental income. But we really couldn't use any of the real estate to save taxes on your medical income because you made too much income, right? You made too much income, so the real estate expenses were limited. So John and Meyer asked about, cost segregation, right? Like, hey, well, a lot of my friends do this accelerated depreciation. Did that, should we do that? Does that help us? And the CPA said, well, no, not really. Those things are too expensive and you just have single family homes. So cost segregation doesn't make sense. It's actually really just for, larger properties, apartments and things like that. So it's going to be too expensive for you. And in fact, their CPA told them that they shouldn't even take depreciation because if you take depreciation in the future when you sell, you're just going to have to pay higher taxes when you sell. So that was their conservative way of saying, let's not even take any depreciation at all. But what was really interesting about this whole story that we heard from John and Myra was that all of that was actually very incorrect. And so we did a couple of things when we did planning with them the following year to make sure they actually take advantage of all those benefits they lost out on.
Yeah. So when we first started working with them, the first thing we helped Myra do is kind of take over more of the duties for her real estate. So she was spending some time on real estate, but we had her kind of reanalyze that and start spending a lot more time on real estate so she could qualify as a real estate professional. So by spending spending the right amount of hours during the year on her rentals, they were able to use their rental losses, create rental losses through cost segregation and other things, and use those losses to offset John's high medical income. So that was benefit number one right there, right? That they weren't utilizing before. Again, they were not having to pay any taxes on the rental income, but now we were able to kind of strategically create some losses and use that to offset his medical income. Um, they also had their teenage kids help out in their business. That was another thing that kind of they had just percolate in their head that their CPA had said, hey, you can't really take advantage. There's no real benefit of doing that. But they had their kids help out, kind of cleaning some properties, doing some light duties on the real estate, helping with the marketing and things like that, some of the online stuff. And so they're able to pay the kids close to $10,000 for the year. And for them, that was tax-free income to the kids. And it was a full write-off for John and Myra. And to Amanda's point earlier, right? This is money they're already giving their kids, right? We know that. So now we're finding a way to make it tax deductible and tax advantage for the family.
Yeah. I mean, the fact that their CPA didn't really take depreciation was, we were able to correct that in the year that we did the tax return because they could do what's called an accounting method change and effectively be able to catch up for what was missed and also accelerate from future years. So just with a couple of rental properties, again, the slight shift in what Myra actually did on a day-to-day basis, they were able to get over 122,000 in taxes saved based on their current portfolio. Now, all of this was possible because she was able to qualify as real estate professional. I know Kenji and Leiti talk a lot about real estate professional status. If the term real estate professional is new to you, excuse me, you can check out our website at KeystoneCPA.com or our YouTube channel. We have a lot of information about what exactly that is, what kind of hours qualify, because that could be just like an 8-hour class specifically on that. But that's the key. If you have one person who's not working full time and you're investing in real estate, it's actually a really great strategy to utilize. It's kind of, we call it the tax loophole for married couples. If you're married and you are in a position to do this, it's absolutely possible to do. If a stay-at-home spouse or stay-at-home mom in Colorado can do it, then so can you, right?
We were discussing, again, married couple where one person can qualify as a real estate professional, working on long-term rentals. But we know that there's a lot of different options out there right now. And so that's kind of the next step in the process is you need to understand and determine what your investment plans are.
Yeah, and part of that too, for a lot of our clients, when we talk about tax planning, it is helping them determine what is that ideal investment. Because people might come to us with, I want to invest in this type of asset, but if you also want to maximize your tax benefits, then maybe it's a different type of asset. So that's step 3 in our process to look at effective tax planning. There's long-term rentals. There's a lot of buzz about midterm rentals. We have a lot of clients doing very successfully in that. There's the BRRRR strategy where you buy a property, value add through rehabs, refinance it, and do it all over again. So one thing to keep in mind is all those first 3 we talked about are considered long-term rentals for tax purposes, which means that if you want to use it to offset your W-2 or other medical income, then you or spouse have to become a real estate professional to get the benefit. Now, the last one listed on here is the short-term rentals. Short-term rentals typically is when you rent out properties on Airbnb or Vrbo. If a property where the average guest stay for that year is 7 days or less, then it falls under a different set of tax law. And this works really, really well for someone who maybe is working still full-time outside of real estate, or if you're a married couple where both of you are still working full-time outside of real estate. We have a lot of clients in this scenario, especially for people in the medical field, because a lot of people don't want to quit what they're doing to do real estate full time or become landlords, right? It's kind of like, I want to do what my profession is. That's what I'm passionate about. But I also want to start building wealth in real estate. And I want that to just always be a side hustle for me. And so in those profiles, if that's your profile, investing in short-term rentals could be a really good strategy because not only does it allow you to get cash flow and appreciation, but you could potentially use tax losses to offset W-2 and other income, even though you're not a real estate professional. All you have to do is make sure you meet material participation hours requirements.
Yeah, and so we do have a lot of clients doing short-term rentals. It is a great strategy. The threshold to meet material participation is a lot, can be a lot easier than real estate professional. Just so you guys know, for material participation, there's 7 different ways you can meet it, but really we talk about 3 of them because 4 of them don't apply to 99% of the people out there. So the first one is, did you spend at least 500 hours a year working on your short-term rental or short-term rentals if you have more than one? Now, if you can't get the 500 hours for some reason, then we go down to the next test. Did you spend at least 100 hours during the year on your short-term rentals? And it's more time than any other single business or any other single person spent on your short-term rentals. So example might be you have 120 hours. You look around and you had the same contractor work on 3 different properties, and the time they spent added up to 110 hours. If that's the most, and you had more than them, then you had more than 100, you can qualify. If you can't get to 100 hours for some reason, the third test is any amount of your time, as long as it's more than the combined time of everybody who spent time on your properties, then you have met that material participation test. So again, you just have to meet one of the 3, but if you can meet one of these tests and strategically create losses through cost segregation studies, income shifting, maximize your deductions, then you can use those short-term rental losses to offset W-2 and other types of income on your return.
Yeah, we'll go over an example right now just so you can see, like, put some numbers to it. It's really important to understand too, because another question we get a lot is like, how many rentals do I have? Like, the examples are all great, but I might just buy like one rental.
Yeah, how many do I need, right?
Yeah. Like, do I need to like buy a bunch? So, excuse me. So this is one where, so this example is where we had a client who just had one short-term rental. So Lexi is a ophthalmologist. I never know how to say that correctly. I think she makes a little over $300,000. So Lexi's single lady,
ready to mingle, hasn't found the real estate professional yet.
Yeah, she hasn't found anyone that she was ready to marry yet. And like many people, she wasn't really interested in quitting her profession to do real estate full time. So when she came to us, she actually heard us speak at a midterm rental conference, and she said, I really want to invest in midterm rentals. That seems to be the thing. I mean, I'm in the medical professional. I already know how I can
traveling nurses.
Yeah, traveling nurses get all settled and all that. So one of the things we talked about was, okay, well, that's all great, but if you're doing midterm rentals, like true midterm rentals, you can't really use it to offset your W-2 income. And the reason is because you're working full time, you're not going to be a real estate professional. So one of the strategies that we worked with her on is, okay, well, then let's find a property that could act both as a short-term rental and as a midterm rental. Obviously, from our perspective, we wanted it to be a short-term rental so that she could use the short-term rental loophole, right? So what ended up happening was she bought one single family home. And in that first year, she operated it as a short-term rental. I think she had maybe like 4 to 6 months that it was in service and was operated as a short-term rental. And because she was able to meet the material participation hours requirements, we were able to do a cost segregation study and get a very large write-off on the property itself, also writing off all the furnishings, the Pelotons, the game, the supplies, everything that she had put into the short-term rental property. And that saved her a very significant amount in taxes. So, again, with one rental property, single family, short-term rental, she was able to get over 84,000 in tax savings. And what happened was in the following year, because it was already staged, she then turned it into a midterm rental, and she was able to become a little bit less hands-on, which was kind of her longer-term goal anyways, right?
So yeah, this is a great example of multi-year tax planning, right? Like finding the property that's not going to just work right now, but looking at the long-term horizon, what's going to happen in 3 to 5 years. And so for this, she was able to kind of use the facts and the situation to her advantage for the first year, convert it to a midterm rental, where it started performing even better actually in the second year. And that really set her moving on her real estate journey.
So step 4 of our tax strategies or tax saving process is the right legal entities. And this is a pretty big one because we see a lot of mistakes being made in this area. Earlier we talked about how, hey, you can write off expenses, depreciation, pay your kids. You don't need an LLC for any of that. However, an entity is oftentimes helpful from a liability protection perspective. So normally if you're, going to invest in rental real estate, your attorney will work with you to figure out, where the LLC should be formed, how many rentals it should hold. From the tax perspective, there's two things that is very important. One is understanding the cost benefit. Okay. I think if we leave it up to attorneys, they'll probably just go like super crazy with number of entities and different tiers and management companies and corporations. And that's all perfectly fine. But as an investor, you want to know, what is it going to cost me to do it? And I don't just mean the cost to form it. I mean the cost to maintain it, the cost to keep books for each entity, the cost to do tax returns or state fees that you have, right? So that's where your CPA comes in to help you look at the cost benefit of your entity structure. I think the biggest mistake area we see are when investors inadvertently or under bad tax advice put rentals in corporations. So very, very important to understand that if you own rental real estate, whether it's long-term, short-term, mid-term, the rentals typically will be held in LLCs or partnerships. Very rarely, if ever, do we recommend them to be held in corporations. And the reason is when you hold rentals in corporations, oftentimes you're unable to take advantage of the tax benefits that come with rental real estate, even if you're a real estate professional, even if you're using short-term rental loophole. So very important that we have the right legal entities in this part of the tax planning process.
So we discussed kind of the various steps, right? So finding money, tapping into your assets to find money for your deals, maximizing your tax deductions, identifying the right type of investment for your situation, and then having the right legal entity. And the last piece of the puzzle is to actually have a tax plan and implement a tax plan and put it in place.
Yeah, I think, I feel like the main reason people overpay in taxes is because they just don't do tax planning. Like most people think they do tax planning when they are getting their tax returns filed. And that's not a picture of me, by the way.
Or anyone that works at our office.
Or that.
This is when I used to have more hair.
But the reality is, as a CPA or as CPAs, that we do tax returns for people. Accountants are not doing tax planning for clients when they're doing their tax returns. When you meet with them in March and April to do tax returns, all they're doing is looking at what did or didn't happen last year and trying to make sense of it all and trying to help you file the best return possible based on last year's facts. What I always recommend is that you set aside another date and time to do a meeting or a call with your tax person to do tax planning for the upcoming year. This is actually the best time of the year to do tax planning because we have a little bit of time before the end of the year. So if there were mistakes or things that you could actually do between now and year end to save on taxes, you have a little bit of time left to be able to maximize your tax savings.
So here's a fact to throw out there is that there was a study that showed that close to 75% of Americans overpay in their taxes. So again, over 75%. So obviously naturally the next question is like, well, like, am I overpaying my taxes? Are you overpaying your taxes? And unfortunately, we can't answer that question for you, right? Because we don't know your situation.
But we did put together a tax risk assessment. You can just scan the QR code or take a picture or a screenshot of it. You can just get it from our website. Basically, the tax risk assessment, we developed it. It's a self-assessment that covers 4 areas. It's personal, investing, retirement, and just general areas. You can answer a series of questions for each segment, and what you'll get at the end is a score. And if you score high, that's great. It means you're doing better than most people we meet. If you score low, that's also okay too, because what you can do is you can print out the results and you can take that to your tax person when you meet with them next. And you can share with them like, hey, I took this little assessment and here are the things I said no to. And you can use that as a starting point when you talk with them to see what are maybe some areas of opportunity that you can still take advantage of before the end of the year.
Yeah, and so it's a great assessment. It kind of will give you that picture of, what am I missing out on? What are some opportunities I could take advantage of? Because it is important that, to understand the tax changes are coming, right? They're coming down the pipeline.
Yeah, and I also think too, when you're meeting with your tax person, here's how you know if they're actually doing tax planning. Okay, if you find yourself in this planning meeting, where it's a series of questions that you ask, like, hey, can I do the short-term rental loophole? Should I do cost segregation? Should I do this? Should I do that? That is a really good sign that you're not doing tax planning. It's basically a Q&A where you learn some stuff, you watched it on YouTube and you ask them and they'll tell you yes or no. True tax planning, I know we have a lot of physicians here. It's kind of like when you go see a doctor, right? It's as a physician, you are asking patients a very specific set of questions to diagnose the problem and then prescribe a treatment plan. So that's the same way for taxes. When you do tax planning, when we do it at least, it's a lot of questions we're asking. Like, what did you do already? What are you planning on doing? Where's the bottleneck? When do we think this will happen? How much are we talking about? Who are you partnering with? Because those questions will help us to determine what is the best next step to make sure we save on taxes, right? So just a little tip right there. But like Matt said, taxes are going up. I think a lot of people right now are talking about the election, what's proposed, but what people are not talking about are what are the facts. And the facts are that the current lower tax rate is set to expire as of the end of next year. So after the end of next year, naturally, without any changes, regardless of who is elected, individual tax rates are going from 37 to 39%.
They're going to probably cut the standard deduction in half. Bonus depreciation continues to go down every single year. The estate tax exemption might be cut in half. I mean, the government's basically printing money, right? So at some point, we all have to pay up and pay the piper, right? So, we can't change the law ourselves, but we can change our facts to legally take advantage of the opportunities that are available to us, though.
Yeah, and that's such an important point. If you want to pay less tax, you have to make sure you have the right facts. And that's really what tax planning is all about. It's about having the right facts so that it meets what the government wants you to do. There's a saying that to build wealth, you have to learn the language of money. What we say is to protect your wealth and keep your wealth, you have to learn the language of taxes. So we hope that everybody has learned something new from this, and you take the time before the end of the year to meet with your tax person and get some tax planning in place. And don't wait until December or end of December, because your CPA might also be traveling or, I don't know, just on vacation. So the sooner you do it, the better it is.